I'm Simon Hartzell, and this is NAI Global's Diving into Commercial Real Estate.
Welcome to another episode of NAI Global's Diving into Commercial Real Estate. You are joining us for part two of a two-part podcast with a firm called Valuation Alliance. This podcast is called Valuing Your Brokerage Company. And today I have Obie Walli, founder and managing partner, along with Fred Schmidt, managing partner. Thank you, gentlemen, for joining us.
Thank you, Simon. We're excited to be on today and wishing everyone within the NAI family staying healthy and safe during this time as well.
Same to everybody on your end as well. So let's dive right into it. Obie, tell the audience a little bit about your background and how you came up in the commercial or the real estate industry, I should say.
Sure. So my background, 20 years in both finance and real estate. Started my career on Wall Street, was an investment banker. Did that for a couple of years and then got an opportunity to join Sendon at the time in their M&A group. They were one of the largest real estate companies and had a division that was acquiring real estate services companies across the country. So started as an analyst there and then worked on probably about 60 or 70 M&A transactions across the country and underwrote about 400 or 500 transactions overall during my tenure there. From there, I transitioned into the operating side of the business, working kind of through the organization, and then got a chance to work with Fred, who was the president and COO of Coldwell Banker Commercial on the operations side. And then in 2012, I went out on my own, started up my own brokerage company as part of the Coldwell Banker Commercial Network, based in Manhattan. Built it primarily through acquisitions, forming partnerships, etc. And we grew to the second largest company within the network with 10 offices and over 150 people. We sold that business back in 2016. So we kind of rode the wave coming out of the downturn. We're able to take advantage of pricing for businesses on the lower end and rode it as the market priced up and then sold. And then coming out of that, after my non-compete expired, I realized that there was a void in the market within our industry where you had all these independent operators and owners, and there wasn't really anyone or any entity or any business providing real guidance and kind of direction to these principals on understanding what their businesses are worth, helping them through the process of transitioning their business in areas of just succession planning, selling their business, acquiring another company, etc. So I launched Valuation Alliance back in 2017, and honestly, the business really grew as a purely just word of mouth. And here we are 2 years later, and we've got a client base that pretty much services the industry across the board, across the country. So we're very excited about the growth of our business. Very excited to work with firms in our industry. It's a passion of ours, and it's a way for us to also give insight and guidance to a lot of the industry that's quite frankly privately held businesses that struggle and get rewarded for their success as well. So that's been our journey.
Well, you guys have a great background, and I can see the synergies between you and Fred to bring value to organizations. I find from my experience of talking with brokerage firms is a lot of these firms, the top producer is the owner. So it's sometimes that they're great brokers or great at putting deals together, but maybe not always the right person to be running the organization. I share that because maybe you guys come across similar experience or something different in your experience. How do you see with owners kind of managing a business, but also being a top producer?
Yeah, it's a very common theme across the industry. It's the we'll call it the player coach model, right? A lot of these businesses, quite honestly, start off as one or two individuals that are producers, and the business starts to grow. You start to bring in talent, you start to grow your business, and one of the biggest challenges is that you get to a point in the growth of a business where you have to make a decision whether you're going to be focused on production and building your income stream, or you're getting to a point where you're managing people and building a business. And I think that's probably one of the biggest struggles that we see in the industry is, are you building a lifestyle company where you can sustain as a player coach, and that translates to the impact it has on value as a business, or are you building a company, an entity where you have services and individuals that need to be managed and requires a lot more support as well, and your time versus being able to produce and stay at those levels. I will tell you that most businesses are in that player coach kind of structure, right, where you have owners that account for a large swath of the income, and that typically then translates into other potential areas of concern as you're growing the business and potentially even looking for some sort of exit or transition, because a lot of the value is tied to a small group of individuals, and in most cases they could be principals as well.
Do you have a sense of where's that break point when you have, as a player coach, to kind of let go of the reins and start moving your clients to other producers within the organization? Is there a point, or is there a metric that's used that you suggest that these player coaches should be considering?
Yeah, and what we've seen in the industry is it really depends on the makeup of your brokers, right? I mean, are they more senior producers, tenured, that don't need much support and you can still continue to do deals? You don't have to manage them as much, or are you bringing up talent, training them, investing time in them? And that's really the litmus test, right? If you're investing your time and effort in bringing new talent in and developing talent, then that number typically falls between 5 and 7. At that point, it's hard to be able to do both, because you're really having to manage. When you have a more diverse team of individuals that are seasoned producers versus new to the business, that number tends to creep up to about 12 to 15 before you're starting to get materially impacted and have to make a decision to say, I can't keep going without having to focus my time and efforts on the business versus in the business.
Well, and that brings up a good point, because then I find, or maybe you could tell us how firms figure out what they're worth. Where's the value, or what key metrics are they looking at to determine that value that they should be looking at for their firm?
Yeah, the general valuation process, and we're specifically here in this case speaking to brokerage services, is really, the biggest challenge is your assets have legs. And in a lot of cases, in most cases, those assets are independent contractors of the firm. So, valuation of a business is a function of how diversified is that revenue, how connected is that revenue from a stickiness standpoint to the business. So based on the services you're offering, the culture you've built, in some cases it's tied to relationships, right? A lot of value in the relationships that are held with the business. And those are variables that we look at, in addition to other variables, size and scale of the company, geography, market plays a big role. How much concentration and density is there in transaction volume-wise? So those all have a key factor into that specific valuation aspect. But one thing to keep in mind is that when you have a business where a lion's share of the revenue is being driven by, call it the principal, if you're looking to monetize that business and you take the principal's production out, in 9 out of 10 times you're dealing with an illiquid asset, right? There's not much value after you take them out of the business. And so that's where the struggle comes in, because we've talked to many businesses where you have a company where 60-70% of the revenue is coming from the shareholders. They're looking to monetize their business, and they very quickly realize that. And if that monetization strategy is an exit, looking at the end of your career, it's a reality check, because they quickly realize that, well, my business isn't worth nearly as much as I thought it was, because when you take me out of the equation, the valuation is pretty nominal. And that's the differentiation between a lifestyle company and what I call kind of building a real business. And that's really where people start to realize that, okay, maybe the way I built this may not have been the best way, but that doesn't mean you still can't monetize it. It just means that the monetization of it is at a different level than what was anticipated.
Well, I really see the value in what you guys offer, because you're more than just, hey, we're going to come in, we're going to tell you what you're worth, and that's it. Like, you're more of an advisory firm, third-party firm, an outside set of eyes to these brokerage companies. And you're talking about things that I could probably say 95% of companies aren't considering or even thinking about. So there's you're bringing up a lot of good points, which I think will hopefully resonate with our listeners and come across as things that they need to start considering. I'm going to shift a little bit into where we're currently sitting in a socioeconomic state and what companies were worth 2 months ago and what they're valued at today. Can you give a little bit of sense on how brokerage is currently being valued and kind of the state, or not to ask for a crystal ball, but kind of those historical changes to where we're at today?
Yeah, it's a great question. It's probably the top question that we get asked. We've been getting asked in the last couple of weeks, 2 to 3 weeks, is where is this taking our valuation? So, as we are in uncharted territories, right? I mean, we've seen a impact to our business overnight. Transactions we were working on have come to a full halt. Activity on the acquisition side is just, everybody's on hold. The unknown here is, how deep and wide is this, or how deep and narrow is this? And so the unknown here is that, valuations coronavirus were trading at some healthy levels for anywhere from 4 to 4.5x to as high as 5x earnings. Where does that sit today? Yeah, I mean, valuations can drop, and the downturn, just to give you a sense, during the economic crisis coming out of 2008 and 9, valuations were as low as 2.5 times for businesses.
Wow.
And so there just was no real sense of strength and stability in earnings. We're coming into an environment where potentially there's no revenue for businesses with all these shelter-in-place orders. So you're going to see a significant drop, and then coming out of that, the recovery. So that's a really difficult question to answer, but my guess, and this is purely just an estimate because there's no comps right now to verify it, but valuing a business in today's environment without having any sort of confidence or guidance in where the revenue stream is, valuations could be as low as less than 2 times earnings. And so it's a pretty scary time from that perspective, but that doesn't mean that obviously at some point we're coming out of this and numbers are going to get better, but I don't see any transactions happening, and if they do happen in this environment, they're going to be distress sales.
Mm-hmm. Mm-hmm. So you think that there will be some distress out of what we're going through?
Absolutely. Yeah. I mean,
that's kind of a loaded question.
Yeah. Yeah. I mean, look, the reality is we're talking about the majority of the country being, in a shelter-in-place orders from the counties and government. Number one. Number two is, if real estate is not defined as a essential business in those markets, then you're pretty much in lockdown, right? So when you think about kind of what we've been doing the last week and a half is talking to customers about what they should be doing immediately. Essentially preservation of cash, cutting costs to just essential costs, working with vendors to defer payments, because if you think about it, you're talking about the potential of having zero income for 30, 60 days. And if you don't have the cash reserves to preserve your business, it's going to be challenging, right? So, we're kind of looking at this and saying, here's our advice. Here's what we recommend. But if we think that if there are any transactions that occur during this time, they will be structured around situations where businesses are unable to continue to operate, and that's probably the biggest risk right now.
And that's
not
where
to be doom
the
and gloom,
potential
but
struggle.
Yeah,
no, it's a reality of.
But it's a reality. Yeah,
it sounds like. Yeah, it sounds good that you guys are having these conversations with clients, because again, it goes back to you're the outside advisor, so you're helping to guide them through these uncharted times, which everyone's hopeful is short term and temporary, so you can get back to the earnings level or the multiple that people were used to. And talk to us about that. When the market is kind of stable and things are moving in the upward direction, where do you see that multiple fall? What's a good range for a sustainable firm?
Yeah, so typically the industry standard historically is brokerage companies trade on a multiple of earnings, and historically those earnings range anywhere from 3 times to 5 times, and there's a lot of variables that go into that range. But just as a overall kind of range, it is 3 to 5x. So, eventually it's going to come back to those levels. And at the peak, they were trading at slightly higher than 5x, just because the market was so strong and frothy. But that's pretty much where we expect it to stabilize at. At some point in the future, it'll come back to that trend. But that's the historical average of where those trading multiples were.
Now, you talk about trading. Tell the audience a little bit about how you would describe earnouts and how that relates to the M&A world.
Sure. So, our business is it's transactional. B, it's a service industry. C, the revenue is tied to transactions, and then your individuals within the company that are trading or transacting in those deals are independent contractors, right? So the typical deal that's getting done in the market, and this is in a normal market, companies get valued based on some sort of adjusted earnings, and adjusted earnings are typically a function of normalized cash flows. So what do I mean by that? So earnings the definition of earnings is the EBITDA, and EBITDA essentially is earnings before interest, taxes, depreciation, and amortization, or what we call cash flow. So you take that, you put a multiple to it, and then typically the way the deals are structured is there's a cash component. Cash component is anywhere from ranges anywhere from 25 to 50%, right? And it's all a function of how healthy those cash flows are. And then you've got an earnout, and the earnouts typically will run anywhere from 2 to 4 years. So on the average, it's a 3-year earnout, and those earnouts are pegged to performance of the business at the time of the valuation, based on what the purchase price was. So you have some performance hurdles you have to hit. Those performance hurdles can range anywhere from top line revenue to gross margins, and all the way down to earnings. And in a lot of cases, the reason they do that is because that is, essentially retaining the revenue stream to protect the downside risk of what the value of the business was, because obviously your greatest risk is your assets could walk out that door, and there's no protection against that, and the only way to protect against that is through the earnout.
Gotcha. Yeah, that makes sense, because I can see this tying back to succession planning, where if you don't have a plan in place and you try to go through this valuation process, it's kind of you're missing something before you kind of get to that point of what's my company worth, or you're late in the game and making those decisions of, all right, do I sell? Do I sell internally, externally? I could see that being a big part of what we discussed in our first podcast. So I can see the importance of the overlap between the two.
Yeah, and in today's environment, discounting the current situation, but typically what we've seen in the last 6 months is firms, we're in an aging demographic, right? The average principal of a company is approaching their mid-50s. So we're going through a very interesting time in our industry where we're seeing a demographic shift in ownership. And that's causing a lot of discussions on what are my options as a principal. I can do three things. I can sell my business to a third party, but then you got to look at the market and say, well, who are those viable prospects to buy my company? And if you're a smaller company, those prospects are limited, right? B, I can transition my business to the next generation of leadership, and that's another process, right? Now you got to go through what was talked about in the previous podcast, and there's a whole exercise to go through that. Or C, I just keep going, and the business essentially dies with me, right? For lack of a better term. And really that's where we're at. And we're seeing a lot of these discussions where principals have come out of a downturn, have ridden a 10-year wave. A lot of these owners don't want to go through this again, and here we are, right? Because it took them a long time to get back to where they were, to build the value of their business and grind it out and get to a point where they have the cash flows where they can now start thinking about things. But that's the challenge we're in, and hopefully this is a very short-term impact to our overall business. But we're going to probably see a lot more activity coming out of this because nobody wants to have to go through this again. So I think we're in for some really interesting times coming out of this current environment, and we'll probably see a lot of activity and a lot of discussions that are going to happen.
Agree. And it always makes me want to I want to smack my forehead, because I talk to a lot of brokerage firms and they say, I'm just going to retire in 4 years. I've been in the business 40 years and I'm just going to close the doors. And I'm like, you're leaving all that value on the table, and that's your plan. But it's each to their own, but I feel like there's other options that are out there, kind of like what you're alluding to, and some of those options that people maybe haven't considered. So I appreciate you going over some of those options. Shifting gears a little bit, and I wanted to ask you, what's the synergistic deals? Can you tell us about that and what that means?
Sure. So, probably one of the most common transactions that occur between two parties and are deals that are synergistic. And what that means is where you have a buyer that's looking to acquire another firm that has the opportunity to consolidate the two businesses and be able to eliminate redundancies. So, and typically those redundancies are in your two biggest categories. Number one is space. So if you've got two locations that are very close to each other, there's no reason to have two locations within 2 or 3 miles of each other, right? You can easily consolidate those. And number two is space, and number two is people, if you have redundant roles. And number three is just cost savings from the standpoint of insurance and technology for services and other areas that where you're just double paying for services twice. You can easily leverage spend there. So I'll give you an example of what that means. A buyer may look at a firm that has an earning stream of $200,000. They peg value at call it 4 times 200, $800,000. Now, a buyer may say that this deal is highly synergistic to me. So what does that mean? If that company has, let's say, $100,000, $150,000, $200,000 of expenses, and I'm just using 200,000 for a round number, and they can save, say, 50 grand out of that 200. So knock those expenses from 200 to 150. The earning stream goes from 200 to 250, right? At a 4x multiple to the buyer, that's worth $1 million, but to the seller, that's 5x, right? So that's the difference in a synergistic deal. Is you'll see transactions occur out there where some people say, well, I got a 6 times earnings. And the first question I asked is, I said, well, who's the buyer? And what did they do to your company? Did they consolidate? Did they make some changes? And 9 out of 10 times the answer is yes, we consolidated. I said, okay, well then, to you is a 6-time multiple, but I'm 100% sure to the buyer is probably a 4x or 4.25 or whatever that number is, but it was much less than 6. So that's really the synergistic transaction. And again, those advantages go to the buyer. So there's buyers out there that will pay what appears to be a higher value for a business when in fact internally it's probably right where market is based on the synergies that are incorporated into the transaction.
That's interesting, and I'm sure firms and some that are listening haven't considered those overlapping synergies between the two firms and how it affects their value. When you're talking to firms, and maybe you can kind of get in more details about segmenting a purchase price or telling us the difference between, I have a firm and it consists of just brokerage or brokerage and property management. How does that affect the pricing?
Yeah, sure. So property management historically has been valued at a higher multiple than brokerage, and primarily the reason for that is because of the stickiness of revenue. It's contractual. You've got contracts in place. You've got recurring cash flow streams, more stabilized. So, when we're looking at firms that have both businesses as part of their overall organization, we'll value those and peg value to each entity based on what they contribute and obviously the higher value going to the PM side from a multiple standpoint. So let's say you have, as an example, a brokerage and a property management business, and both are generating the same cash flows. And let's just use the same number, 200,000 each in earnings. You could get a 4x for the brokerage, and you could get a 5x for the PM. So your PM business would be worth, call it $1 million, and your brokerage company is worth 800,000. And that's typically how we break those out, and then we'll underwrite them accordingly.
Mm-hmm. And you've given some good examples throughout this podcast, and I know there's probably a lot more details that go into it, but what are some of the pricing issues that you come across when you're speaking with firms or evaluating?
So pricing issues as far as coming up with the value or structuring the deal?
Let's look at both. I think
Okay.
You've kind of alluded to the pricing, but when you're evaluating, I think in your due diligence, what are some of those challenges or issues?
Yeah. So, the biggest challenge when you're underwriting deals from a pricing standpoint, and we'll look at it through two sets of lenses. Number one is during the valuation is, typically when you're valuing a business, you're looking at adjusted earnings. So the number one question is, what are those adjustments and how real are those adjustments? And do you want to give credit for those adjustments, right? And that's the number one underwriting guideline when you're doing due diligence is let's validate the adjustments to make sure that the earnings stream of the business is in fact what we believe it is based on the numbers we were provided and the feedback we got from the principals. So that's kind of from the valuation side. When it comes to structuring the deal, it's all about cash. Cash is king, right? So the number one issue there is how much cash can I get up front and how much is going towards the earnout. And I will tell you that, the driver of cash is really a function of how stable are those earnings, how stabilized, how diversified is your revenue stream, how much of that revenue is at risk based on concentration on maybe a small group of agents or a team outside of the ownership, right? Because there's a risk of fallout. There's a risk of losing that business. So typically what you'll see is when you have a high concentration risk of earnings tied to, let's say, one or two individuals or a small team, it's going to impact your cash. Because what a lot of ways to alleviate that is you'll see deals where buyers may come in and say, well, we're going to allocate X to your business. If you're willing to lock up your people or this individual or this team, we'll give you more cash, right? Now, it's a double-edged sword because in order for you to lock that individual up, you have to talk to them. And in most cases, you're going to have to probably allocate some dollars to them as well. Yeah,
it's a lot of what you're taking from succession planning, kind of implementing or over time putting into these brokers' day-to-day business. So they don't have to have these conversations all at once during just valuing their company or selling or whatever it might be. It's kind of these conversations can go over time to lead to an easier transition, or as you're doing, if it's a pure M&A, you've kind of done all the upfront work. So that's why I find it's important for, if a company's considering or hasn't gone through the succession or valuation process, they really need to talk to you guys. Like, that's the bottom line, because there's a lot of things that need to be considered based on what you're telling me here today. And I think it's important for firms to kind of take those next steps. And like you mentioned, now is a great time to be proactive and consider what's your company structure and what's it worth.
Absolutely. I agree with you.
Well, let's jump into it. We talked about a lot of details here from very high level, and in a second I'll let you give your contact information to our listeners. But two quick fun questions. In the shelter-in-place environment we're in, have you gone to your favorite food or developed a new favorite food in your diet?
So my favorite food is pizza. Pizza lover. And so we've gone from ordering pizza in to making it at home. So it hasn't changed. We're just eating more of it. But yeah, that's pretty much it. You know, we have 3 kids at home, so we're trying to make that, you know, like just last night, as a matter of fact, the 3 of myself and my wife and our 3 kids, we made pizza together. So it was great. And so we're trying to make it as engaging as possible with trying to keep our kids busy as well. So
that's awesome. And last question, you just won $10 million tax-free. Where do you allocate those dollars in commercial real estate?
In today's environment?
Yeah, that's it's a challenging one. Because I could say, hey, tell it to me 4 weeks ago, and it'd probably be
yeah. I mean, so I am a firm believer in kind of the generally, you know, I've invested in industrial real estate, and I still believe that, given just the general current environment, I still believe it's a good asset class. If I had to invest it in any asset class, it would be there. Just because, you know, I think there's going to be, you know, again, the whole supply chain logistics, the ability to probably have more demand on online shopping, and the need for having that type of product to be able to move it around, and probably more demand for it. So if in today's environment, that's where I put the money, invest in that asset class.
Perfect. Perfect. Great. Well, Obie, Fred, again, I appreciate this was a lot of information between these 2 podcasts condensed into a short amount of time. So I really encourage our listeners to take the proactive approach, reach out to you guys. What's the best way if firms are considering any of this succession planning or valuing their firm? How do they reach out to you, Obie? What's the best way?
Sure. You know, you can reach me directly at my email at obie@valuationalliance.com. My phone number, direct call, is 973-865-5821, 973-865-5821. And you can also reach out to our website at valuationalliance.com. And we have the ability to kind of just have a contact form there, so you can contact us through there as well.
Perfect. Awesome. Thank you very much, both again to you and Fred. Any questions about NAI Global, feel free to email us at help@naiglobal.com. Thank you for listening.